Ever look at one of those big company financial reports and just think, ugh, there's got to be a simpler way to get what's really going on? Well, you're definitely in the right place. You, our listener, pointed us to a recent SEC filing. It's Occidental Petroleum's Form 10Q. And we're going to dive deep, really extract the key bits without getting totally bogged down in the financial jargon.
Yeah, Occidental, or OXY as most people know them, they're a huge player. Oil and gas, chemicals, they're into quite a bit. And this 10Q, it gives us a really detailed picture of how they did in the first quarter of 2025. So the period ending this past March.
Yes, exactly. Think of this as like your express lane to understanding their financial story for those first 3 months. We're zeroing in on, what they earned, what they spent, the big financial moves they made. No need for you to wade through hundreds of pages or doing that heavy lifting. I mean, this report, it's packed. You've got the balance sheet, what they own, what they owe, the income statement, profits, cash flow, tracking the actual money moving around. And of course, you get management's own spin on things too.
Yeah.
Okay, let's unpack this.
Right. So looking at the kind of the big picture first, Occidental's total assets as of March 31st, 2025, they were sitting at about $85 billion, 84.967 billion to be precise. That's actually down just a little bit from the end of 2024 when it was more like $85.4 billion.
Okay, a slight dip in assets. What about liabilities, what they owe?
Liabilities also saw a modest decrease. They went from roughly $51.3 billion down to about $49.9 billion. But what's really interesting, I think, is their net income, the profit that actually goes to the common stockholders. For Q1 2025, that came in at $766 million.
$766 million. And how does that stack up against the same time last year? Is that what we'd expect, or is it telling us something?
Yeah, good question. So Q1 of 2024, their net income for common stockholders was $718 million. So yeah, we're definitely seeing an increase there, a decent jump.
Okay.
And this uptick, it shows up in their earnings per share too. EPS from continuing operations, the basic calculation went from $0.60 last year to $1.81 this Q1.
Right.
Diluted EPS also went up 56 to $1.77. And pretty much the same story for net income per share. Basic held at 81 cents. Diluted went from $0.75 to 77 cents.
Okay, so it seems like boosting revenue was probably a big part of that better performance. Let's dig into the revenue side then. What really drove that $6.8 billion in net sales for Q1 25?
Yeah.
Especially compared to just under $6 billion last year.
Yeah, the main thing driving that increase was definitely higher sales volumes. That was the big story. And it was particularly strong in their oil and gas segment, the Crown Rock acquisition that played a really big part there. If you break down the revenue, oil and gas was like way out in front. $5.683 billion in net sales just from that segment in Q1 chemical segment. That brought in about $1.2 billion, $1.187 billion technically, and then midstream and marketing added $312 million.
Wow. Yeah, oil and gas is clearly the powerhouse.
Yeah.
What else can you tell us about that segment? Was it just volumes or did prices help too?
It's actually a bit of a mixed bag on prices. For their U.S. oil, the average price they got was $70.80 a barrel in Q1. That was actually down from over $75 in Q1 last year.
Okay, down.
International oil prices, same story, down from about $78 to $72.50. But, and this is important, U.S. NGL prices, that's natural gas liquids, they saw a big jump from around $21 up to nearly $26 per barrel equivalent. And domestic natural gas prices also saw a nice increase from $1.61 up to $2.42 per McCaf.
Huh. So, yeah, some pressure on oil prices, but a boost from NGLs and natural gas. And you said the volume effect was huge.
Absolutely. The average daily sales volumes in oil and gas, big increases, especially stateside. U.S. oil volumes went from 487,000 barrels a day in Q1 24 up to 601,000 in Q1 25.
Wow.
Yeah. And similar jumps for NGLs and natural gas volumes, too. It's, like I said, largely down to integrating that Crown Rock acquisition. It closed late last year, and now it's really adding to their production numbers.
That makes total sense. Yeah, Crown Rock seems to be making a real difference already. What about the other parts of the business? Chemicals, midstream, and marketing. How'd they do?
Well, the chemical segment, their segment earnings were $185 million in Q1 25. That's actually down from $254 million the year before.
Oh, okay. Why the drop?
Mostly driven by lower prices they got for key stuff like caustic soda and PVC. Plus, they faced higher costs for some raw materials like ethylene and natural gas, which they need to, make their chemicals.
Right, squeeze margins. And Midstream and marketing, you mentioned that was a loss.
Yeah, that segment reported a loss from continuing operations before tax of $77 million in Q1 25, which is, well, a bigger loss than the $33 million they had in Q1 24.
What happened there?
Primarily seems to be tighter margins related to the timing of their crude oil sales, just how things fell this quarter. They did get some help from higher sulfur prices, but yeah, it wasn't enough to get the segment into the black for the quarter.
Okay, so clearer picture on the revenue drivers and the segment performance. Now, let's flip to the other side. Where did the money go? What were the main expenses for OXY?
The big categories, well, you've got oil and gas lease operating expense. That was about $1.2 billion in Q1 25, a bit up from $1.16 billion last year. Transportation and gathering costs also climbed from $353 million up to $413 million, probably linked to those higher production volumes, right?
Yeah, makes sense.
Interestingly, the actual cost of sales for the chemicals and midstream parts, that actually dipped slightly from $828 million down to $801 million.
Huh. What about those big non-cash charges like depreciation and that sort of thing? How are they looking?
Right. Depreciation, depletion, and amortization, DD&A. Basically accounting for the value used up for different assets. Physical stuff, oil reserves, intangible things. That category saw a pretty noticeable increase. It went from about $1.7 billion in Q1 24 up to over $1.9 billion in Q1 25.
Okay. Why the jump there?
That's directly tied to the CrownRock acquisition again. They brought a whole lot of new oil and gas reserves and equipment onto their books. So naturally, the expense tied to, using up those reserves depletion and the depreciation on the new gear, that's going to be higher.
Got it. CrownRock's impact showing up on the expense side, too. Yeah. So with all that revenue and all those costs, where did they end up before taxes?
Income from continuing operations before income taxes landed at $1.332 billion for Q1 25. It's a pretty significant jump from the $1.01 billion they posted in Q1 24.
Nice increase. Yeah. And the tax rate?
Their effective tax rate for the quarter was 29%, just a hair lower than the 30% rate they had in Q1 last year. That rate gets pushed around by, where they make their money geographically. The U.S. federal rate is 21%, but international rates can be way higher, sometimes up to 55%, the report mentioned.
Wow. Yeah, those international rules can really swing things. The report also mentioned, just briefly, the Inflation Reduction Act, the IRA, and that OECD Pillar 2 thing. Any immediate impact there?
According to them, not really. Not yet, anyway. They said they're, keeping an eye on how the rules are developing for the IRA and how Pillar 2 is being rolled out in different countries. But at this point, they don't expect any, material impact on their financials or cash flow from those right now.
Okay. Let's pivot a bit to the balance sheet. Let's talk debt and liquidity, cash on hand. How's their debt situation?
Okay, debt. As of March 31st, 2025, Occidental had just over $24 billion in long-term debt. Outstanding, net of adjustments, $24.037 billion. But what really jumps out is how active they were in managing that debt during the first quarter. They paid off $465 million of senior notes that were coming due this year. And they also paid down $50 million on a term loan.
Right. They've been pretty vocal about wanting to cut down debt. Sounds like they're making real progress. I mean, beyond just saving on interest, how does chipping away at that debt help them? Does it give them more room to maneuver, maybe?
Oh, absolutely. That's a crucial point. By lowering their debt, yeah, they cut future interest payments, which frees up cash. That's obvious. But it also just makes their whole balance sheet stronger. And that stronger financial footing, it gives them more flexibility, maybe for future deals, maybe investing in new tech. And it makes them tougher, more resilient if energy prices get choppy or take a downturn. Lower debt just means less financial risk, generally.
Yeah, that makes perfect sense. So actively managing the liability side. What about liquidity? How much, ready cash do they have?
Their liquidity looks pretty solid. End of March, they had $2.6 billion in cash equivalents. Plus, they had access to another $4.15 billion under their main credit line, their revolving credit facility, and another $600 million available through a receivables facility. So plenty of access to funds.
Okay.
And actually, something happened after the quarter ended in April. They did a warrant exercise. It brought in about $890 million, and they specifically used that cash to pay down even more debt. They even lowered the exercise price for a bit to encourage people to use the warrants, and it clearly worked.
Smart move, yeah. Get the cash in, pay down debt. Seems like they're really playing offense and defense with the balance sheet. Speaking of assets, obviously CrownRock was the big addition. How's that being treated in the books?
Yeah, the CrownRock deal back in December 2023, $12.4 billion, that's definitely shaping these results. Accounting-wise, it's a standard business combination. They're still finalizing some minor bits of allocating the price to all the specific assets and liabilities they got, but that's pretty normal. The main impact we're seeing is just that huge boost in oil and gas reserves and production, like we talked about with revenue. It's not just boosting numbers now, it gives them a much bigger footprint in a really key shale area that could mean long-term growth, maybe better efficiency down the line.
Right. And on the flip side, they've also been selling some stuff, right? Divesting assets. What's the plan there?
Exactly. In Q1, they sold off some non-core royalty interests up in the DJ Basin, got about $900 million for those. And they also sold some other non-core bits in the Permian Basin for around $400 million. For accounting, these were just treated as like normal retirements, so no big gains or losses recorded. And the strategy seems pretty clear. Sell off the stuff that's not central to their main plans, focus their efforts, and use the cash generated for priorities like paying down debt.
Makes sense. Streamlining. Okay, let's shift gears slightly. Environmental stuff, legal matters. Always important for big energy companies. What's the latest there?
Okay, environmental. As of March 31st, OXY reported total liabilities for environmental cleanup remediation of $1.901 billion. This covers 157 different sites that categorize them, based on whether they're on the EPA's Superfund list, APL, or if they're currently operated, closed sites, etc. They also estimate that it's reasonably possible they might have to spend another $1.9 million on top of what's already booked. It's a range, of course.
And that Diamond Alkali Superfund site, that's been around a while. Any news on OXY's part in that?
Yeah, OxyChem, that's their chemical subsidiary, is still heavily involved in the cleanup there. The Diamond Alkali site, or DAS, it's broken into 4 parts, operable units, or OJUs. They're doing different things in each one, like maintenance and monitoring in one, feasibility studies in another, design work elsewhere, all directed by the EPA. OxyChem has set aside money, a reserve, to cover what they think their share of the cleanup costs will be. But, the final bill could always end up being higher or lower.
Right, always uncertainty with those long-term cleanups. Any other major legal things jumping out from the report?
Well, the report does flag that ongoing tax dispute. It relates back to a big settlement payment they made in 2015 connected to the Tronox bankruptcy case, which itself stemmed from the Anadarko acquisition way back. Basically, if the tax court rules against them on a deduction they originally took, OXY might have to pay back about $1.4 billion in taxes, federal and state, plus interest, which was already up to $805 million by the end of March.
Oof, that's potentially a big number.
Yeah, they do have a liability recorded on their books for that possibility. But importantly, they noted that reserves for any other lawsuits or claims weren't considered material right now.
Okay, so before we kind of wrap this off, let's just quickly touch back on the main business segments. Beyond just the headline revenue and profit numbers, what other things are they, and analysts, likely watching closely for each segment?
Sure. So for oil and gas, besides volumes and prices, it's things like production cost per barrel, lease operating expenses per barrel. Basically, how efficiently are they getting the stuff out of the ground? In the chemical segment, it's all about those price spreads. The difference between what they pay for inputs, like natural gas, and what they get for outputs, like caustic soda or PVC. Those commodity price relationships are critical. And for midstream and marketing, it's about margins on crude oil and natural gas trading and transport, and how efficiently they're running their pipelines and storage. The CODM, the chief operating decision maker, they're regularly looking at all these segment-specific metrics to, gauge the health of each business and decide where to put resources.
Right, the nitty-gritty performance indicators.
Yeah.
And finally, just this standard boilerplate, but important.
Yeah.
The forward-looking statements disclaimer.
Yeah, absolutely essential to mention. The 10-Q, like all these filings, has that cautionary note about forward-looking statements. These are basically the company's guesses and predictions about the future. They're based on what they know now. But, the future's uncertain, lots of risks, lots of things could happen to make the actual results turn out differently. So while those statements give you insight into management's thinking, you can't take them as, guarantees.
Okay, great reminder. So let's try and synthesize all this. If you had to boil it down, what are the absolute core takeaways from this deep dive into OXY's Q1 2025?
Okay, key highlights for me are: 1, definitely that increase in both net sales and net income compared to last year, driven largely by oil and gas, fueled significantly by CrownRock. 2, the very noticeable activity on the debt reduction front, paying down notes, term loans, using asset sale money that warrant exercise cash, clearly a big focus. And 3, you've got those ongoing factors to watch: the environmental liabilities, which are substantial, and that potential hit from the Anadarko-related tax dispute.
Yeah, definitely some clear themes. It's fascinating seeing how fast Crown Rock is impacting the top line, like you said, and just how deliberate they're being about cleaning up the balance sheet. Very strategic moves. So, okay, here's a final thought for you, our listener, to chew on. Given this progress they've made on cutting debt and these ongoing asset sales,
Yeah.
how might OXY position itself now? How do they balance trying to grow, dealing with volatile energy markets, while juggling these big priorities, keeping production up, paying dividends, cutting debt even more, and also investing in those low-carbon ventures they talk about? It feels like a really complex balancing act.
It absolutely is multifaceted. No easy answers there. And this Q1 report, it really just gives us a valuable snapshot of where they are right now, financially and strategically. To really get the full picture of where they're headed long term, you've got to keep watching. Keep an eye on future filings, company news, see how they execute on all those different fronts.